What if I told you the biggest AI opportunity of the decade still hasn't happened yet? Everyone's talking about Nvidia. The stock exploded. The headlines screamed. And maybe you looked at the chart and thought, I missed it. But here's the truth. You didn't miss a thing. Because the next wave of AI gains, the ones that create real wealth, isn't about hype. It's about strategy. And the smartest investors? They're not chasing headlines. They're targeting 3 AI giants that are still trading at ridiculously cheap valuations. If you care about growth, innovation, and investing before the next breakout, this is the video you've been waiting for. Let's dive in. 1. Taiwan Semiconductor Manufacturing Company, TSMC. This is the company behind the AI revolution. Yet, it's still flying under most investors' radar. Founded in 1987, TSMC revolutionized the chip industry by doing one thing and doing it better than anyone else, manufacturing chips for the biggest tech names on Earth. We're talking Apple, Nvidia, AMD, Qualcomm, all rely on TSMC. In fact, TSMC is the only company in the world currently producing chips at the 3-nanometer scale at meaningful volume. That's cutting-edge territory. With AI chip demand expected to grow 45% annually over the next 5 years, TSMC is projecting solid 20% compound annual growth. Its new Arizona plant is already fully booked through 2027. Yet, the valuation? Just 21x forward earnings. That's surprisingly cheap for a company with near-monopoly status in high-performance chip manufacturing. Risks? Geopolitical tensions. Most of TSMC's operations are based in Taiwan, and China's ambitions toward the island keep investors on edge. Plus, they're spending billions on new fabs in the US, Japan, and Germany, putting short-term pressure on margins. But ask yourself, if you could own the factory that powers every major AI player, wouldn't you want in? TSMC may be quiet, but it's the company every loud company depends on. 2. Nvidia, ticker Nvidia. And finally, we've got the heavyweight, Nvidia. If AI has a heartbeat, Nvidia is the pacemaker. Founded in 1993 by Jensen Huang and 2 fellow engineers, Nvidia began as a graphics chipmaker for gamers. Fast forward to today, and it's the undisputed leader in AI hardware. Its chips power everything from ChatGPT to autonomous vehicles to high-frequency trading. Nvidia's A100 and H100 GPUs, they're the gold standard in data centers. Even as giants like Amazon and Google try to build their own chips, Nvidia's CUDA software ecosystem and advanced architecture keep them ahead of the game. Developers trust it. Enterprises rely on it. Now, after all that growth, is Nvidia still a buy? In 2024, revenue doubled. Data center growth exploded. And with AI adoption accelerating, Nvidia's total addressable market is growing faster than anyone expected. Pros? 80% market share in AI chips, software stickiness, pricing power, and deep cloud partnerships. Risks? Margins have dropped from 78% to around 70%. And if cloud giants like Amazon or Microsoft slow AI spend or go fully in-house, Nvidia could feel the squeeze. Still, ask yourself, if AI is just getting started, can you really afford to bet against the company that made it mainstream? 3. Alphabet, ticker Google/Google. Let's kick things off with a tech titan that helped build the internet. Alphabet, the parent company of Google, YouTube, and a fast-growing suite of AI platforms. Founded in a Silicon Valley garage back in 1998, Google changed how the world finds information. Today, Alphabet isn't just a search engine. It's a cloud leader, an AI powerhouse, and a silent force in autonomous vehicles and even quantum computing. Yes, Alphabet has had its fair share of challenges, AI threatening its core search business, antitrust lawsuits from the DOJ, and whispers of a possible corporate breakup. But look closer. In Q1 of 2025, search revenue still grew over 10%. YouTube usage hit all-time highs. AI is being infused across Google Search, Gmail, Docs, and more, thanks to Gemini and AI overviews. This is a company evolving in real time. Best part? Alphabet is still a cash machine. generating over $100 billion a year in free cash flow. And the stock trades at just 17.5x forward earnings. That's value territory for a company with global dominance. Risks? Regulatory pressure, possible restructuring, and fierce AI competition from OpenAI, Meta, and others. But here's the twist. If Alphabet does get broken up, it might unlock more value, just like we saw with PayPal and eBay. So here's the question. Would you rather chase the headlines or own the infrastructure that runs the digital world? Line them up side by side, and you see the full picture. Small blue diamond, Nvidia. The AI chip king with nearly 75% gross margins and zero dividend, focused purely on growth and domination. A $3.2 trillion market cap says the world believes in its future. Small blue diamond, TSMC. The quiet titan behind the scenes, still yielding a solid 1.2% dividend with a $1 trillion market cap and a monopoly on advanced chip manufacturing. Small blue diamond, Alphabet. The digital empire, pulling in $350 billion in revenue, strong 58.5% margins, and a modest dividend. Plus, it's still sitting on a war chest of cash and innovation. So here's the real question. If AI is going to define the next decade, what kind of companies do you want in your portfolio?